I mean, it's hard not to smile when a cow makes that noise, but
It really isn't. Yeah, no,
Yeah.
it
Anuj,
just sets the tone.
Yeah, right. Anuj, thanks for doing this.
Thanks for having me.
So what I like to start off with is two things. I want to frame the business and frame your backstory, because I think that guides things in the right way. So whatever order you want to go in, what's your story and how does it relate back to the business currently?
Yeah, and I appreciate that. I like starting out that way. I think maybe just to set the stage a bit. So I lead the ESG and sustainability efforts at my company called Stax. And what we do is our clients are mostly private equity firms, investment banks, and the companies that the private equity firms invest in. And we have sort of three pillars, I'd say, just generally speaking, of work that we do. We advise private equity firms buy side. So before they buy an asset, we do something called commercial due diligence. When they own the asset, we help private equity firms, the management teams of the portfolio companies that they've invested in, on value creation initiatives. And that's there's different things that we can do under that sort of monolith of value creation. And then when a company is looking to be exited, a private equity firm, an investment bank, the portfolio company may hire us to help them position themselves in the market, tell their story, and help attract the future buyers. So it's all with privately held firms. I joined the firm last July, so this was July of 2023, and what I'm tasked with doing, and what I've been doing, is integrating environmental, social, and governance considerations into each of those three pillars, our three offerings. And our approach at Stax is somewhat different than what I think most people who think of ESG or ESG analysis, the way that they think about it is it's separate. It's something that is done sort of as a separate analysis work stream alongside something else. And you kind of pair the two together and you look at an overall picture. We're taking somewhat of a different approach here, which is we are embedding ESG analysis into our other core offerings. So commercial due diligence, which is the product that we have for our clients buy side, so pre-investment, we embed something called ESG due diligence within commercial due diligence. So we're essentially in some ways expanding what commercial due diligence means. And this is a differentiated approach in the marketplace. I was attracted to the opportunity at Stax and what our firm was doing with our clients. Number one, based on the strength of the relationships that we have with our clients, very strong. We've been in business for 30 years. We work with some of the world's most well-known, highly regarded private equity firms. So the strength of those relationships was something that appealed to me. The strength of the firm, my colleagues, how talented they are, but also this approach. And for me, ESG here in the US has been politicized. There's a backlash against it. And in my view, that's primarily because the people that are the practitioners of ESG haven't done the hard work, which is to demonstrate that there is commercial value to it. And when we can demonstrate that there's commercial value, there should be no controversy around it. So we take that differentiated approach for our clients.
A million things I want to unpack from your opening.
Yeah.
Thanks for doing that.
Sure.
All right, let's start with two sides to this, and I hear two terms: ESG and due diligence.
Yep.
And so I'm thinking about like how this relates back to business value, and I would imagine on the ESG side, you're finding some of the gaps either in a buy or sell side because it might not be done in a best practice way per that part of this, and then on a due diligence side, it might not be in the traditional sense of what a buyer or seller is considering when it comes to how does this relate back to the value. Is that an accurate statement?
That's exactly it. I think in some ways the ESG space has done itself a disservice by framing it as something that is very different than business as usual. And when we think about it as something as business as usual, what we're really doing is we're widening the aperture of the lens at which you look through risk and opportunity for a business. I use this analogy. I mean, this works for the US. I'm a a baseball fan, and let's go Mets. I have to say that because I'm a Mets fan. But I think back to the movie Moneyball, and there's this pivotal scene, or right at the beginning of the film, where Brad Pitt is sitting around the table with a lot of his old school scouts, right? This is the Oakland A's, and this is Billy Beane back in the 80s, 90s. And he is struggling, Brad Pitt, Billy Beane, is struggling to get his colleagues at the table to think differently about how to construct a baseball team. And what he is using and what is emerging in the field and what has emerged in sports generally over the last 30, 35 years is analytics. And so GMs use data. They use old school methods. There's a feel, there's a touch to baseball, which is his colleagues at the table were using feel and touch, and this person just looks like a baseball player. And you can't discount both, right? So ESG is data, full stop. Companies disclose material information on environmental, social, and governance factors. Investors are downstream from that data. You can choose to do what you want with that data. You can ignore it. I would say you do so at your own peril. But include that data as an input into your investment process. So it's not that these issues or these factors didn't exist before for companies. We didn't measure them. And now that we measure them, and there are regulations in different jurisdictions around the world that regulate the type of data, that are increasing the quality of that data, that are increasing the standardization of that data, which allows us to compare one company to another. But that data is now available to us. So we're just including that as part of an investment process that already exists. And that to me is where we're sort of missing the mark as an ESG community, is thinking about it as something differentiated. It's a different work stream. No, it's an input into an existing work stream. And again, that's what we're doing at Stax. It's part of commercial due diligence. We can take the controversy around of ESG out of it, completely out of the equation, if we can demonstrate that there's financial value. Now, that's easier said than done. ESG and ESG factors, typically what you need to do is it's a connect the dot exercise. It's not a financial metric, or it's not widely considered a financial metric. If you think about employee turnover or workplace injuries, those are not necessarily considered financial metrics, but you can draw a connection to a financial metric. Maybe it's one stop away, maybe it's two stops away, but you can say that, the company's reputation would be harmed. And if you can improve performance on this one factor, you can improve the company's reputation, which would improve the valuation of the company. And so to me, this is critical. It's critical that almost really it impacts every firm in any industry. There are certain industries where it's more critical to think about this, now rather than in the future.
All right, follow-up question on that. First of all, my kids' middle names are Wrigley and Field, so that's what team I cheer for. However, I'm going next week on Wednesday to the Mets game because I've decided I'm going to be a Mets fan throughout the playoffs.
We welcome it. We have a big tent.
Yeah,
we welcome Chicago Cubs fans. We welcome everyone pretty much except for Phillies fans.
Yeah, right. Well, they're crying right now. So
yeah.
The Billy Beane reference is fantastic, and here's what I'm unpacking in my mind. Like, I hear that it's not a financial impact, but let's just say if we're taking a zero line, and the reality is if a company is pre-thinking of the ESG impact, and some of the tools or data sets are going to place early, in my opinion, that actually increases the swing of the valuation, because if it isn't in place and it's a blind spot and the cost to get up to standard is so extreme, then the blind side on the buyer side could be very, very expensive. So whatever X multiple you paid, now you're going to have to add this whole other thing in here because we're not thinking about it. For when you were talking, just because I was curious of what happens if I search for ESG and private equity, because I hadn't beforehand. And the indicator, and this is back from July of 22 is Harvard Business Review is saying private equity should take the lead in sustainability. And so like it's there, but like if I really look at what's out there when it comes to ESG and private equity as a search term, there's not a lot. And the last thing I'll say, then I want your comments, is, in my opinion, that then I go towards, okay, what can this impact be from a financial side on the buyer and the seller side? Because if the seller put the pieces in place, the valuation goes up and you've protected the buyer's interest when they get involved, especially if you're taking another turn on the business. And so I look at that, I'm like, okay, now I get into the Stax website and there's like a very simple landing page that isn't diving into this. I feel like, and I wasn't planning to uncover this discussion, but I feel like it is the analytics hitting baseball and how do you craft a team. It's there, and clearly indicators. If Harvard Business Review is talking about sustainability, it's there. Just nobody is really owning it, or nobody knows how to own it. So if I were Stax, I would build this out as a framework on part of your why you why now.
Yeah, it's a quite a complicated ecosystem. So to get back to maybe how I started to do this work. So I've been doing ESG advisory for about 6.5, approaching 7 years now. Prior to that, 20 years in the capital markets. I worked at Bankers Trust. I worked at Morgan Stanley. I worked at Lehman Brothers. I worked back at Morgan Stanley. And so my training has been in the capital markets. And for me, when I pivoted to ESG, I, in some ways, didn't see that much of a pivot as perhaps others would see. You know, I saw this as a continuum, as a straight line from capital markets to ESG. To me, it's still capital markets. And so that's my approach. My approach has always been, well, it has to make sense from a value creation perspective. If I was in the public markets, I would say it would have to make sense from a share price perspective. It has to increase the price per share because that's how you're valuing a company. Now, what has happened, let's say, over the last decade or so, and ESG has been around for a long time. There are investors that have taken these approaches for quite a long time. They've recognized that these factors impact the valuation of companies. They just didn't call it ESG. There wasn't a whole ESG ecosystem that was around it. And so there were a number of precipitating factors. Obviously, climate change is one of the bigger ones. There are negative externalities that any company in any industry produces negative externalities. And a lot of times society bears the cost of those negative externalities. And what society was demanding was data on what are those negative externalities. So companies would start to publish some of that data voluntarily, let's say. Then there's a wider movement that says, well, hey, this data is actually quite useful, but one company's calling it one thing, another company's calling another thing. I'm not sure what their methods are behind the scenes to measure this. I feel like they're measuring the same thing, but they're calling it two different things. But I want to compare and contrast because I'm an investor and I want to know who's a better performer. Mm-hmm. And so you have efforts that have organized to sort of regulate the disclosure of ESG data. We need investors. We need standardized data. We need comparable data. And then when you get into that, it starts to get a bit more complicated. You have different jurisdictions. The EU is pretty much ahead of the US. Different areas of the world adopt different standards and jurisdictions. You have cross-jurisdiction standard setting organizations that are trying to be the standard that different countries, different regions around the world adopt. But then, there's you get into a little politics there. You certainly do get into politics. And then I'd say I started doing this work in 2018 or so. And then the pandemic hit, and George Floyd's murder was a very big precipitating event that sort of catapulted ESG because corporates, and there were demands from stakeholders, right? Let's just say ordinary citizens, but then ultimately it became LPs, in asset owners that own all the capital. But societal pressure to say, we need to do better. right? We need to do better as a society on a whole host of issues. So, hey, LPs that are holding my pension assets, we need you to do better. LPs say, okay, GPs, you're the ones that actually manage the money. We need you to do better. And here's the data that we want to see from you. So GPs start to say, okay, we need to disclose this information. And somewhere in between there, there's a disconnect between what actually should be disclosed because it's tied to value creation versus someone just says, hey, here's a huge set of data that we want to see from you as an organization, disclose that to us. And that's where it left the opening for a backlash, for a politicization, which basically says this is woke nonsense, right? Like this is not moving the needle, number one. And the backlash came actually from both sides. They would come from people who would say, yeah, these investors need to do better on society and they need to prioritize this, but they're not. ESG is not doing anything to move the needle on societal issues. And then you've got criticism coming from one side that's basically saying this is woke nonsense. This is virtue signaling. This isn't doing anything. And it's actually a burden on companies. It's a burden on investors. And it's really not doing anything. And I'm sitting there and I'm saying, well, I know that the work that I'm doing for my clients is meaningful because I'm tying it to financial factors. I'm not putting anything in front of them that I don't think will help them run their business better. And so we need to do better as a community, as an ESG community, to talk about our approaches. That being said, there is a large ecosystem of ESG rating providers, ESG reporting, ESG software, ESG standards and regulators. There's very large law firms have big ESG businesses now. They'll have 10, 20, 30 lawyers that are working on ESG regulations and helping companies do this. There are mandatory disclosure requirements. In the EU, they have something called the Corporate Sustainability Reporting Directive, or CSRD, which mandates publicly traded and privately held firms disclose sustainability metrics. And some of it is there's almost 900 data points in certain parts that companies have to disclose. That is an enormous burden on firms to disclose that type of information. So you've got heads of ESG being hired. You have heads of sustainability. You have teams of people being hired. Now, I kind of take an approach where I'm like, but if we're talking about it as business as usual, why is there so much of this going on? Shouldn't it just fit into what we already do or what firms are doing? So we're trying to thread that needle. There's certainly new stuff, but there's also, if you can fit it into an existing framework, that's probably the best way to do it.
I mean, the philosophies that you're talking about end up being quite large because, and you know the impact, but you could take an example of the George Floyd moment, that all of a sudden companies jumped to make a change. And if you said, how much has that change been sustained today? It's probably questionable. It was like it had to be done in that moment. And so what you're saying over here is, well, wait a second, I know what the financial impact is by building this into just business as usual, but it needs to be as a part of the way that we operate businesses. Just as you have a marketing department, you need to have this fit into the way that you do marketing, because it is a PR story.
And listen, companies can do what they want in terms of supporting the communities in which they operate in. There's corporate social responsibility, CSR efforts. It's not to take away from that. And that certainly is something that it's up to any corporate and the management team of those firms to pursue. What do they want to do? Define what those priorities are and to do that work. Now, that's separate, though, from ESG, right? ESG is tied to financial value creation. It's risk. It's, in some ways, it's identifying the risks, managing those risks, but then there are also opportunities on the value creation side. And then what we haven't discussed, but we're sort of touching upon, is impact, right? When I'm saying that we need to reduce carbon emissions because we want to limit global warming across the world, that would be impact. If you have an intentional strategy as an organization to reduce your carbon emissions, because that's, again, what you want to do, or you see that it's tied to financial value creation, that's the impact side of things. But there has to be an intention to do that. ESG, to me, we're trying to just get it to it's business as usual. It's just, we don't question now in sports the use of analytics. It has become business as usual. Now, for teams, as we know, for baseball teams, certainly if we stay in that world, for a team that goes all in 100% on analytics and crafts the team without actually using some of that old school, it doesn't work. We know that, right? It has to be a balance between the two. And so we're not saying we're replacing anything. It's just a way that fits into an existing framework. We just have more data to use. Why wouldn't we use this data?
So philosophically, and maybe it's more than philosophically, but you take analytics. It took the Oakland Athletics that were supposed to be last place, winning 20 plus games in a row, for baseball to have this moment. If I think about impact moments to what we're talking about, we could go to hurricanes, we could go to George Floyd. Like, there are things that have been loud enough and impactful enough financially back to business that you would think that would wake this to be there. What's it going to take for this to just be a part of, like, where do you see this having to go?
It's great. I mean, I think what you're touching upon, Nick, is how do you prioritize those efforts within a firm and within your business strategy or corporate strategy? I think the hurricane analogy is obviously we feel for the folks down in Florida and Hurricane Milton and Helene, and these are major impacts. But okay, so let's see what's happening though. From an insurance standpoint, it is very difficult, if not impossible, to get flood insurance in those parts of Florida. And so what does that now mean for those communities? That is, if you can't get insurance and you're looking to buy a home, you can't get a mortgage. So that is, a bank's not going to give you a mortgage. And we're seeing the impacts. See the impact of Hurricane Helene in Asheville, North Carolina, far away from the coast. It's in the mountains. Now, what does that mean for those communities trying to get flood insurance? It's going to be really difficult. I wrote something earlier this year about the drop in home insurance markets in Iowa. And this was because of freak storms, we're all experiencing this no matter where we live, where we're seeing these storms with major intensity. They're short, but there's major intensity. I live in a building in Cambridge, Massachusetts, and we're somewhat in a floodplain. And when we get these freak storms, it always floods for my poor neighbors that live down in the basement. This is a climate change impact. Our building's insurance policy, we have a master insurance policy. Our previous master insurance policy provider dropped us, and we now had to find someone else who will insure us. We have less coverage, and our premiums all went up. And so these are the impacts. So what does it take? On certain issues, perhaps we're almost too far removed, right? On climate, the impacts are here, right? The climate has changed. I mean, that's what I say for anyone who is above, that lived on this planet for a few decades or more. We can think back to our own childhoods when we know that the weather is different than when it was when we were, children. So the climate has changed. So where do we go from here? What's next? I don't have the answers. I think a lot of it is leadership. For us, we're advisors to our clients. We're trying to help them see the issues. We're trying to help them see that these are things that if they manage them well, they will manage risk, they'll mitigate risk, or they can actually even seize opportunities to create value. If they can do it and their competitors aren't doing it, that's a good thing. That will help increase valuation. That makes them more attractive to the next potential buyer. So that's the work we're doing. I can do the work that I can do, but I can't do all of the work in the space.
If I think about like where this progression in business, because we are at the end of the day, we are talking about impact from a financial standpoint, and when the wealthiest of wealthy see impact on financial,
it moves the needle,
right? So I think about like home inspection. Home inspection forever has been done by buyers coming in to buy a house. Home inspector comes in, says everything is wrong. They say, here's the credit that I need to go ahead and move forward with this purchase, and I'll make decisions on how much I want to fix up and don't. In your case, you're coming in and you're saying, hey, business, look at all the things that are potential impacts when this goes to sell. It's almost like a home inspection. But the shift that's happened with home inspection is now home sellers are saying, "Ooh, wait, if I fix these things up before selling the house, the valuation of my house is going to be higher, and therefore I'm going to get more money out of this." And now that like changed the needle, because now the home seller thinks about fixing things up versus just passing it all onto the
That's
home
a
buyer.
great analogy. In your house, you fix those things up, and the house next door to you that's also for sale hasn't fixed those things up. And maybe there's people who are like, okay, I'm ready for a project. But then there's a lot of other people who say, I don't want to take that project on, and they're bidding up the value of your home. And so it's increasing valuations. And so these are interesting things. I write an annual sort of top 10 ESG trends, and I'm starting to prepare it. I release it at the end of the year. And one of the issues, just a very quick preview, is choice. So in electric vehicles and EV vehicles, Toyota, their fleet, they have a lot of choice. They have hydrogen powered vehicles, they have hybrids, they have plug-in hybrids, they have internal combustion engines, they have EV. And that's what I think as consumers you want choice. And so this to me is, this is where the world is headed. Sustainability is an imperative. Another thing that a lot of folks in my space talk about is we have all of the plastic in the world that we need. There should be no new plastic being created. We have to think about how to recycle that. We have to think about creating new products from the existing plastic that exists, but there should be no new plastic. There's plenty of plastic in the world. So these are the types of solutions. And if you can get more innovative as a company and think about something that's new, that consumers will demand, you can charge a premium for that. And so you can make even more money. So this is, again, there's no conflict with capitalism here. It is part of what we're all trying to do. It is part of the American way. But we've got to get that story out there, and we have to demonstrate that this matters.
Let's conclude on this. So similar to you're at a conference and you're speaking to an audience, and obviously some people are further along on this topic than others. So if you're talking directly to the target decision maker that is like, we need to have this as a part of our toolkit, what do you want them to know about you or Stax in conclusion?
I want them to know that what their priorities are exactly what our priorities are. There is no conflict. When they do well, we do well. And that, frankly, from a Stax perspective, we have experts in-house that understand their industry really well. And so this isn't just me as an ESG person or a sustainability person that doesn't understand business or capital markets or valuations. We have our industry experts who are consultants. We're pairing all of this together to benefit you, our client. So that's really the takeaway. And if I can make sure that people understand that, then we can speak further about how we can work together.
I love this conversation. Again, I still go back to have more impact on that landing page. There's so much beautiful things of this conversation that I think, and no ownership in the space. Like it's talked about in the way that businesses are talking about their positioning. But I think there's something impactful in what we discuss. I would almost extract it all and just put it on a landing page, because I think even your report and your viewpoint on this, like it's going to take education to make change, and clearly you're moving the needle as best as you can. So,
well, I can commit to Nick, we will feature this podcast on our landing page.
Hey, there we go. I love it. Well, thanks for the chat. It was awesome. For Anuj, I'm Nick. Thanks for watching. Take care.